I think the big question right now is that we're seeing that markets and equities, at least in the region, have been in a bit of a wait-and-see pattern because a lot of people are really asking and looking over the Fed going, come on, do something, Jerome Powell and friends. Is that really one of the big, potential catalysts for stocks, and will that keep stocks perhaps range-bound in the region until something happens over in Washington, D.C.?
Yeah, absolutely. 100%, JP.
Absolutely. Okay.
Yeah, okay. So you have, obviously, the interest rates is one of the big cyclical drivers. The pulse of the consumer markets is also a big cyclical driver at the moment, as well as this reindustrialization of the world, which is leading this manufacturing recovery. And you can see those three key cyclical factors play out in those performances you just mentioned. Malaysia has outpaced the region. The region overall has been flat. But Malaysia, when you look at the ASEAN All-share index, which is about $2 trillion of stocks, 12 of your 15 best performers this year are all Malaysian stocks. You've also got GDP coming in Malaysia at that 4% level. And what you do see in Malaysia as well is the consumer sectors, both the staples and the discretionary sectors, are outpacing the region. Which I think is really interesting, because most of the region, most of the outperformance, when you're looking for that alpha across ASEAN, it's either been in utilities, materials, or industrials, or some tech as well, technology as well, because that plays more with not the cyclical drivers, but more those longer term drivers of the pivot to sustainability, more innovation and digitalisation-led infrastructure, as well as the regional economic integration, which is really
now, sticking to Malaysia and just comparing that to Thailand also, is this also perhaps a manifestation of perhaps reforms being implemented structurally in Malaysia that seem to be bearing fruit? And when you compare that to, say, Thailand, where there is a concern that perhaps the economic engine has been having a hard time getting out of second gear, how do you compare these two particular markets, especially for investors who want to take a better understanding of these parts of the region?
Well, first look at the GDP growth rates and look at the drivers of the GDP growth rate. Look at the interest rate differentials. Look at the returns as well in terms of that negative translation into US dollars for the actual local market returns. When you look at those returns for the Malaysian market that you put up just before, when you convert it to US dollars, it's about the same, very much like Singapore. But then when you look at the other countries that have had to keep interest rates higher to defend their currencies, you've got that little bit of underpacing performance. So interest rates and growth are one thing, as well as obviously if you want to take the structural reform type of look, you got to be very cognizant of what's happening in the world with this reindustrialization in the US, in Europe. Two things: the reliance on cheaper labour in Southeast Asia or across Asia. It's not as strong as it used to be 20 years ago, because technology is really, as we talked before, the robots are coming in terms of the industrialisation process, and that is helping the reshoring to the US. And if you've also got other factors as well in that manufacturing process that really kind of seeing the countries per se look to move upstream. Global value chains, regional value chains, there is a race, if you will, to move upstream. Where you see it in semiconductors, moving from the downstream assembly, testing and handling, going up to the fabrication, going up to the chip design. That's where the money is. And these are the kind of segments, these upstream segments, that are going to be, the bigger growth drivers as we go into 2030.